You're not bad with money. The system is just designed to make it look that way. That's not an excuse. That's a mechanism. And once you see it clearly, the whole conversation about spending habits starts to feel like it's pointing at the wrong thing entirely. Every few years, there's a new wave of content about why people can't save money, and almost all of it lands in the same place: behavior, choices, discipline, willpower. The implicit message is always the same. If you're struggling financially, there's something you're doing wrong. You're buying too much coffee. You're eating out too often. You're not tracking your expenses carefully enough. And there's a version of that which is true. Behavior matters. Choices compound. But here's what that framing quietly ignores. The environment in which you make those choices was designed by someone else. The defaults were set before you arrived. The friction, meaning what's easy and what's hard, was engineered, not accidental. When a company makes it effortless to subscribe and confusing to cancel, that's not a neutral experience. When your paycheck lands in an account that earns near zero interest while the bank deploys that same money elsewhere, that's not a coincidence. When every checkout screen asks if you want to round up, add insurance, or upgrade, that's architecture. The question isn't whether you have enough discipline. The question is, what system are you operating inside of, and who built it? Let's talk about what a financial structure actually is, because the word gets used loosely. A structure is the set of defaults, flows, and friction points that determine where your money goes before you make a conscious decision. Most people interact with money reactively. The paycheck comes in, bills pull from it automatically, subscriptions renew quietly. The remainder sits in a checking account with no assignment. Then, at the end of the month, they wonder where it went. That's not a character flaw. That's a structure, just one that was never intentionally designed. The financial services industry, the retail industry, and the subscription economy are all built around one core insight. The path of least resistance wins. If something is automatic, it happens. If something requires a step, most people don't take it. This is why banks put savings one click away, but still see low savings rates. The friction isn't technical, it's psychological, and the system knows that. Meanwhile, spending is frictionless almost everywhere. One-click checkout, buy now, pay later, contactless payment. Every one of these innovations was marketed as convenience, and they are convenient. They're also structurally optimized to reduce the pause between impulse and transaction. The pause is where decisions live. Remove the pause, and you remove the decision. That's the invisible system. It's not a conspiracy, it's just design. And you're inside it right now, whether you've looked at it or not. Let's make this concrete with simple numbers. Imagine two people, same income, $60,000 a year, same expenses, same general lifestyle. Person A has no financial structure. Their paycheck lands in checking, they spend, occasionally move money over to savings when they remember, and generally intend to save more next month. Person B has a basic structure. The day their paycheck arrives, $400 moves automatically to a separate savings account. Not because they have more discipline, because they set up a transfer once, and now it just happens. At the end of month 1, they almost look identical. At the end of year 1, person B has $4,800 set aside that person A does not. Person A didn't spend it frivolously, it just absorbed into the month. Now extend that 10 years with modest investment returns of around 6% annually on that saved amount. Person B has somewhere in the range of $65,000 to $67,000 accumulated from that single structural decision. This is not a motivational video. It is a structural analysis of financial systems. Person A has the same paycheck history and very little to show for it, not because they failed, but because their money had no architecture. The behavior was nearly identical, the structure was not. That gap didn't come from tips or motivation, it came from one automated decision made once, years earlier. Here's where it gets more nuanced. When people operate inside a poorly designed financial structure, money coming in, money going out, nothing clearly assigned, they tend to develop a specific kind of financial anxiety, a low-grade uncertainty about whether they're okay. And that anxiety has a behavioral consequence that almost no one talks about. It pushes people toward short-term certainty. When the future feels vague and untracked, the present becomes more appealing. A purchase today is real. A retirement account in 30 years is abstract. The brain is not irrational, it's just responding to what it can perceive. So the absence of structure doesn't just affect the math, it affects how you experience money emotionally. And that emotional state makes the existing system easier to operate inside of. You spend more reflexively when the future feels distant and unclear. This is how people end up reinforcing the very defaults they'd consciously reject if they saw them laid out plainly. The system doesn't need you to be reckless, it just needs you to be passive. 15 years of a structureless financial life tends to look the same for most people. Income has grown, expenses have grown with it or ahead of it, savings exist but are inconsistent, rebuilt periodically after being drained. There's a retirement account that was opened years ago and rarely examined. There's a vague sense of being behind without a clear picture of what behind even means. None of this is catastrophic in the short term. That's exactly what makes it hard to see. The damage from a structureless financial life is quiet. It accumulates slowly in the background, visible only in comparison to what you could have built, to what the math suggests was possible, to the version of your future that got traded away in small, invisible increments. Most people encounter this clearly only when a major event forces the question. Retirement, a job loss, a health crisis, a sudden need for capital they don't have. At that point, the issue looks like a crisis, but it was a structure. It just took 15 years to become visible. Here's a different way to see this. Your financial life is always running on some kind of structure. There's no neutral position. Money flows somewhere by default. The only question is whether you designed that default or inherited it from systems that had their own interests in mind. Recognizing that is not about blame. It's not about the bank or the algorithm or the checkout screen. It's about understanding that the environment shapes behavior more reliably than willpower does. That's not a weakness. That's how human beings work inside any complex system. The people who tend to build wealth quietly over time are rarely the ones with the most discipline. They're the ones who built an environment where the disciplined behavior happened automatically, where saving wasn't a choice made fresh every month, but a default that ran in the background. They changed the structure once, and then they mostly left it alone. Most people will finish watching this and feel something shift, a recognition, a small clarity about something they hadn't quite named before. And then they'll return to the same structure they woke up inside of. Not because they're not smart enough to see it, but because the system doesn't require your attention to keep running. It just requires your inaction.